All right. Hello, everybody. I am here with Ryan Detrick, Carson Group's Chief Market Strategist. Familiar face now. You've seen him kind of quarter over and again and again and again. And he's our go-to expert to kind of talk about the markets. And I wanted to get this one out quicker, just as we all know, there's a lot of things going on. And Ryan, I know you're a busy guy trying to sort through all the madness that's going on. And so today we're recording this. It is Friday, the 14th of March. We
Yep.
will be working to get this out hopefully by the end of next week. So just know there's a couple days lag there as it goes through compliance. So, but either way, I think now is an important time to kind of really hone in on what's going on in the market. So Ryan, I'm going to start with, yesterday we crossed the magic number 10% into a correction territory. However, we are bouncing back up today. We'll see if it
Yep.
holds. Um, what has been the key drivers of this market correction or this recent sell-off?
Yeah. First off, Steve, thanks for having me back, and hello to everybody. We've got a lot more to talk about. Last couple times we talked about markets going up. It turns out markets can go down, and that's what I'm looking forward to talking about that. Um, the reality is, yes, we just went into what we call a correction in the S&P 500, 10% down, 10% off of the February 19th all-time highs. Here we are a couple of weeks later, and we all know the volatility. Now, here's the thing about markets, right? Markets can take good news, obviously. Markets even can take bad news. Think 5 years ago, right now, the economy shut down, global pandemic, yet we started rallying for many months. I mean, 2020 was actually a good year for investors. I know it wasn't a good year for the economy necessarily. It wasn't a good year for a lot of individual people, but markets can bounce on bad news. Steve, they do not like uncertainty. Listen, I am by no means a tariff expert. I read the same things everyone else reads. We have a lot of uncertainty out there right now. It seems like daily, right? Almost hourly, we get different news, different rumors. Markets don't like that. And that's why we've seen an extremely volatile marketplace. We can get more into kind of some of the weeds of we're not overly surprised. Honestly, the first part of this year is kind of surprising, but I want to put a big picture spin like this, and we can go to the next one. 5 years ago, right now, was a 100-year pandemic, 34% bear market in 5 weeks. 2 years ago, right now, like when I say right now, I'm talking March. Oh, by the way, welcome to March Madness, right? You talk about March Madness. We're there.
Yeah.
2 years ago, right now, regional bank crisis. I know, a lot of your clients, I believe, out west, you're probably a little more into the regional bank crisis, right? The 16th largest bank in the country just disappeared overnight out in California, Silicon Valley Bank. And there was a lot of worry, right, about what that could mean. Well, stocks bottomed and rallied. 5 years ago in March, stocks bottomed and rallied. 2003, we're in a bear market of the tech bubble. Things were not very good out there. Then the terrible war started in Iraq. All of a sudden, markets bottomed, and then they started to rally for 4 years. So we've been in some scary marches before. We've gotten through them, Steve. We're going to get through this one. It's uncomfortable. I hate to say unfortunate because maybe we can get into this a little more. This happens. Markets do go down. Markets are volatile, and scary headlines happen every single year. And we just need to remember that as investors.
Beautiful. So at the start of the year, you guys released your market outlook,
Yep.
which was phenomenal. And you guys had a pretty positive outlook on the S&P.
Mm-hmm.
Was it 10 to 12 or 12 to 15, somewhere in that
Yep.
range? Has that outlook changed now with what's kind of gone on this past, month and a half?
Yeah, that's a $64,000 question right there. As of now, no, right? We've been overweight equities. The previous 2 years, I've come on with you for a while saying we think this economy is going to do better than expected, avoid a recession, and stocks are going to do well. Investors, everyone out there needs to realize after a 70% rally off of the October 22 lows, we came into 2025 knowing a couple things. The first quarter of a post-election year, where we are right now, historically is a really rough quarter. And that's not about President Trump or President Biden or President Obama. This is going back in history. When you have that new leadership, you have 10 new guys in town, things get a little rocky. That we kind of expected that. The first quarter, after a 20% gain, usually markets don't do that well. The first quarter of the last 20 years, Steve, is actually the worst quarter out of all 4 quarters. When you stack these things on top of each other, we're still optimistic. We still think stocks are probably going to gain double digits before this year's over. At the time we're recording this, down about 5% on the S&P. That's a good size move, but the reality again, most years tend to see a 10% peak to trough correction. Okay, I mean, when you look like on average, you see one a year. Now, that means some years have multiple, some years have none. We haven't seen a 10% correction in the S&P 500 since late October 2023. Didn't have one last year. Had an 8% correction or so in the springtime. Another ballpark 8 or 9% correction around August when we had a lot of scare around the yen carry trade unwind. Hopefully, no one even knows what I'm talking about. But that was pretty scary back then. So we said, listen, we probably see a 10% correction. We've been talking about that, writing about that. And it's here, and I know when it's here, it's very uncomfortable. It doesn't feel good. I mean, I do this for a living. It is scary is not the word I want to use, but it's uncomfortable a lot of ways. You see all this stuff, but then you kind of look and you realize, my, oh my, maybe we were just due to shake the tree, get rid of some of the weak branches. And that's kind of how this works. And we're still optimistic the second half of this year, or really even the last 3 quarters of this year, Steve, are going to be pretty solid. And we're still going to have a pretty good year, all things considered.
Beautiful. And I wanted to kind of add to that. So in a
Yeah.
market commentary, I don't know if it was last week or the week before, you had put out a chart talking about the weakness that you can see after, those circumstances you just
Yeah.
explained. 20% years, and you see it in the end of February and March. And
Yeah.
you kind of dive into what the trend line looked like, moving up into May, bouncing off of those years.
Well, I always say hope's not a strategy, but let's hope that works out again, right? I mean, it's amazing. Again, we were making new highs on February 19th. All right. Like around February 16th, 17th, around there, I was on CNBC and they know we've been bullish, right? I was talking to Scott Wapner on CNBC and we've been writing about it, talking about it, like you said. But I said, listen, expect a banana peel coming up. Banana peel sell-off's what I kind of called it. Now, maybe it's a little bit more than a banana peel, but it wasn't a shock to see some weakness right around this time of year. Now, I get it. Everyone says, well, yeah, but because of all the tariff uncertainty. Absolutely. I mean, that's what sparked it. That's what's driving it. But not to get too geeky with this, but there's something called the credit markets, right? Keep this real high level and simple. I think the credit markets are the smartest people in the room. Credit pushes around the stock market. Let's just be very clear. We have data, free data. We can look it up within seconds. Free data on the credit markets. Here's the thing everyone needs to know, Steve. The credit markets are not showing major stress. They're not showing major cracks. Before the pandemic, or I'm sorry, before the great financial crisis, a lot of stress in the credit markets. Before previous bear markets, there's been stress in the credit markets, keeping this kind of high level. We're not seeing stress in the credit markets. To me, I hate to say garden variety pullback because it's like, oh my goodness, if you're in it, it doesn't feel like that. But really, what we're seeing right now is fairly normal. Maybe there's a little more pain to come. Will it turn into a bear market? That's the next logical question for everyone's asking. Bear market means down 20%. We'd say no. And I know I've kind of given a long answer, but I think it's interesting. We had the two closest bear markets in history earlier this decade. Remember, early 2020, 2022. We've never seen two bear markets that close to each other. If this one is a new bear market that started on February 19th, that would be 3 bear markets in 5 years. Steve, that's never happened before. Now, I get it. Anything's possible. We've all done this for a while. Things can happen. But it's extremely rare to see 3 bear markets that close to each other. The previous record was like 7.5 years. We in the 60s, I think late 60s and early 70s, we saw 3 bear markets in about 7.5 years. So just some context around this, but the economy is still solid. Consumer is still okay. Labor market is still solid. Uncertainty is all over the place. One last comment. The word uncertainty, remember Sesame Street, word of the day? Well, uncertainty is the word of the day this month. There's something called the Fed Beige Book. It's kind of looked at how the economy's doing. We're not going to get into that. But the word uncertainty was in the Fed Beige Book 47 times. We've got data back to 1970. That's the most it's ever been cited. Something called the NFIB Small Business Survey. Record number of the word uncertainty. It's everywhere. Something about markets. Uncertainty's high. Markets don't like it. That's where we are. If we start to get just a little certainty, I'm not saying solve all these trade issues. I don't think it's going to happen anytime soon. Nobody really does. But if we start to get some resolutions just a little bit, Steve, what's being priced in is really, really negative stuff. A little bit less negative stuff. That could be that beach ball effect. Take the beach ball under, you release it, then it starts to go. And we think that's still, I'm a glass half full type of guy. I know you are as well. So that's kind of how we see this playing out here.
Awesome. That makes a ton of sense. And so that kind of leads, the beach ball coming up. Could that also be, I mean, there's a lot of talk out there, should we be buying the dip?
Yeah.
That's a headline that you see everywhere. I mean, how do you guys sit on that question, or how do you view that question or answer that?
Yeah, I was just thinking beach ball. Like we got a couple more months still. Got to get ready for going out on the beach. I don't know. I've lost a little bit of weight last couple of months, but I got a little ways to go here. I don't know on that one. Anyway, what'd you ask me? I totally got thinking myself in a swimsuit. Should we buy the pullback, or at least not panic? Let me put it this way. One of the things we've been stressing, and I know you agree on this, to be diversified, right? I mean, stocks have done great. We understand that. But to have a little cash, have a little bonds, have some different parts of a portfolio just for a little safety net in case we're wrong makes a lot of sense. Yes, the S&P 500 is 10% off the highs, but you know what? You look over Europe, Europe's up over double digits. Gold, I mean, gold's doing well. Bonds are doing pretty good this year as well. So yes, if you're all in stocks, it has been uncomfortable. We still think stocks are going to outperform bonds. When we be very, very clear, I say, fixed income kind of helps you sleep at night. So those are some concepts that we're talking about. But to specifically answer your question, what's the saying? Eisenhower said plans are useless, but planning is everything. Well, we've kind of been planning for some volatility the first half of this year, right? We've been talking about, we've been expecting it. Now it's here and it's happening, and it does make you a little squirrely when you think about how every day is kind of so wild out there all of a sudden with those really, really negative headlines. But it's not that surprising, right? So I think it's important to remember that. I mean, if someone has some cash on the sidelines right now, yeah, I mean, I think you definitely could kind of dip your toe in the market in a correction in an economy that's still fairly strong. Yeah, uncertainties out there, trades out there, but yeah, this is a spoiler alert. Every year tends to have scary headlines. Every year tends to have a lot of volatility. If you kind of close your eyes and you just buy when it's scary out there, you know what? Over the next 1 or 2 years, you're probably going to be pretty darn happy you did that. I mean, there's been so many examples of that just the last couple of years. I mean, the yen carry trade unwind in August, that was really scary for 3 days. I mean, people were freaking out for 3 days. And now it's like, oh, yeah. I remember that. I'm not saying the tariff stuff's going to be quite like that, but the reality is, yeah, when things go, stock market's the only place things go on sale. Everybody runs out of the store screaming.
Yeah.
There's some good companies on sale right now, Steve.
Yep. Amen to that. So last question here. What are 2 to 3 indicators? There's so much noise going on out there, so much media hype. If I were to, tell my clients, hey, really keep an eye on these 2 to 3 indicators that could really shape the outcome of the, near term to the rest of the year. What are 3 things that you could peg on?
Yeah, a couple of them. Let's start with earnings, I guess. I mean, earnings in the United States for S&P 500, sorry, was supposed to be up 11% in the fourth quarter year over year, came in up 17, right? Corporate America continues to show profits, continues to grow. So that's important. If earnings start to roll over, and we'll talk about it, we'll share that. If they do, we don't expect it to. Could we have a couple, like ballpark earnings are supposed to grow about, depends on your source. Let's just say between 12 and 15% this year on the S&P 500. If all these tariffs are being floated out there, yeah, that is going to take off some earnings, okay? We're still thinking just April 2nd is kind of when those tariffs go in play. There still could be some bobbing and weaving, still some potential positives on the tariff front, but you might lose a little bit on earnings front, but we're still looking at record earnings this year. The other one is profit margins, right? We have new cycle highs in profit margins right now. Could tariffs and things pressure profit margin a little bit? Yeah, they potentially could, right? Because if things cost a little bit more, maybe you can't push it all on the consumer. So companies have to eat that. That could push profit margins lower. But again, companies have record profit margins. So that's really good. So earnings or profit margins are 2. I'm trying to think of the third one. I kind of already said it, I guess, but I'll say it again. Those credit markets, right? And I'm going to get a little geeky on everybody. Triple B spreads, investment grade corporate spreads. If there's stress in the credit markets, that'll tell us there's a monster under the bed. We just pulled back 10% of the S&P. Steve, we're not seeing stress in the credit market. So we follow those 3 things literally every day, at least every week for sure, but every day if not. And we'll see some cracks in those 3. And if we do, that might tell us our overall bullish thesis is incorrect. But again, that's why we still are preaching a diversified portfolio with overweight equities. Yes, but have some bonds, some cash, maybe some other alternatives and things in there, just to help you sleep at night. Nothing wrong with that, right? But we still like stocks to lead when all is said and done at the end of 2025.
Awesome. You're a genius. Thank you so much, as always, for all this. We really appreciate
we'll see about 9 months. If I'm a genius.
Yeah,
You might take that back. I don't know, but
yeah,
but
we'll
no, Steve,
dangle
I
this video
appreciate it.
in front
I
of you.
do want to say, thanks everyone for having me back, and you're in good hands with Steve. I'm honored to help, and I just love doing these. So Steve, just reach out when you want to do another one, and let's try to have a little more green on the screen next time. But I appreciate it. You can bring us home. Thank you, Steve.
All right. Thanks, Ryan. Be well.